Hi everybody, my name is Dr. Sam Lanzafame. I want to welcome you to our accounting class here, and I hope that this semester turns out to be a great one for you. I know it's probably weird to have to do this remotely, but I can assure you that whatever I would have done in a classroom environment, I'm going to be doing here in this type of environment. So like if we were in class, I'd be writing on the board, or more likely I would be bringing up my, turning on the computer, opening up Excel, projecting it onto the screen, and then type, and you would see exactly what I was typing. So basically it's the same idea. So the only difference is I'm broadcasting from my kitchen instead of the classroom, and but you'll still get the same information. So I'm probably going to turn off the video here, so just my picture will appear there. I got my little COVID beard going, so I've been working on this for a while. So I normally don't have a really thick beard like I have here, but it's 2020. Things are weird. But I want to welcome you to the class. Couple of things that you need to know about is we're probably going to have a weekly session of this, so that you can at least, I guess the best way I can say is for every chapter we do, I will do a video presentation for that chapter, okay? And then whenever we have a test that week, I won't be doing a presentation. So typically the way I like to go is 2 weeks and a test. So then 2 weeks and a test, 2 weeks and a test, 2 weeks and a test, all the way to the end. So that turns out to be 15 weeks. So 2 classes, 1 exam. So that's 3 weeks, and we have a total of 5 exams altogether. So that seems like a pretty good plan. And like I said, I'll try to do, for every chapter that we have, there will be a video for that chapter. And then I'll assign a couple of questions for you to do, or a few questions for you to do. And the good news is, since I'm not in class to kind of go over the homework with you, what I will do is I will upload the solutions to all of the end of chapter questions so that you can see how you did. Okay? And then when it comes time for the tests, all you'll have to do is, open up, I'll probably upload the test in Blackboard under content, and then you just click on it, fill it out, and then email it back to me. So emailing is the way you're going to communicate all of your information back to me. Okay? So we'll have 4 live sessions throughout the semester. So I think I've already put those in my calendar, so just pay note to that. The first one is going to be, tomorrow or today. I probably shouldn't even say that because it depends on when you're opening this. But we will have 4 live sessions, and basically 1 per month. And that's just to kind of make sure you're understanding things, or if you have any questions that you still can't figure out from going over the homework, then that's the opportunity to do so. So those will be live, but they're optional. If you can't make it during those times, that's okay. It'll get recorded, and it'll be sent to you via a link. Okay? So welcome to the class. If you have any questions, the best way to get a hold of me is through email, but even better than that, texting me. And this way I can get to you right away, as opposed to, maybe I don't open my email except for once a day, and I just happen to look at all my emails and you sent it. So it might be like 24 hours before I see it. So text me is the best way. Okay? So we're going to start in with chapter 3 here. Let me take off my video, and you can see my picture of me without my beard, and then we'll go from there. See? Well, I kind of have a beard, but that's my normal look. I got a crazy look going on right now. But I'm looking at chapter 3. So this week we're going to focus on chapter 3. Next week we're going to focus on chapter 4. If you notice, the title of this chapter is The Income Statement and Statement of Changes in Equity. So because we're starting in chapter 3, you are not responsible for chapters 1 and 2. All right, so the focus is going to be from 3 forward. Okay, so I don't want you to think, oh, great, he's going to expect us to go and read 1 and 2 and figure it out on our own. Nope. So we're starting here with chapter 3. That's our first chapter of this class. And if you have your textbook with you, that would be great. If not, no big deal. I'm just going to focus on a few things here. So first thing I would like to do is to bring up on the screen my Excel, and hopefully you can see it. Should be popping up any moment now if it hasn't already. It's telling me that it is sharing, so I'm going to assume that it is correct. So the first chapter is basically focusing on income statements and then also equity. So that's what we're going to do. Chapter 4 is more on balance sheets. So let's go kind of slow here. I don't know how many accounting courses you've taken. I know that people that take this class, some people have taken all their accounting courses, some are in the middle of it. If I were to describe this class, it would probably be a mixture between a little bit of financial accounting and cost accounting, or some people call that managerial accounting. So it's a little twist of both with a little healthcare extra twists to kind of coincide with what we're doing here. So let's start off with, because I don't know exactly everyone's background, but let's start off slow, like I said. So let me introduce you to probably the first income statement you've ever been introduced to. I'm guessing, but I'm going to take a wild guess. And it probably went something like this. You would have your revenue, and underneath revenue, we would have probably service revenue. And then underneath there, we would have expenses. And then you would have underneath there a list of expenses. Definition of a revenue is, what do you do for a living? When you do it, you earn revenue. So if you paint houses for a living, every time you paint a house, revenue. If you clean teeth for a living, every time you clean a patient's teeth, that's revenue. If you are a doctor and you see a patient, that's revenue. If you're a beautician and you cut someone's hair, when you cut their hair, that's revenue. Expenses are those costs to help you operate the business, your rent, your telephone, your utilities, your wages, salaries, any insurance, depreciation, which is another thing that they talk about in this first chapter. So let me just list a few of those. So how about wages expense? And how about telephone expense? And what about depreciation expense? We'll throw in insurance expense. How about rent expense? And I think that's good enough for right now. There could be a whole slew of more of those, but so let's pretend that your wages are $30,000. Telephone expense, let's go 3,000. Depreciation, 12,000. Say your insurance expense is 15,000. Your rent is let's go 12,000. Okay. And what we would do is we would add up all these expenses. And when I do that, and by the way, you don't need to know how to use Excel in this class, but that's the method that I'm going to use for typing purposes. And so you don't have to think, oh great, I've got to do, I've got to know how to use formulas. Nope, you can just use handheld calculators to do stuff. But let's just pretend that the revenue for this business was $100,000 and total expenses, as you can see, amounted to 72. And now I want to subtract the 72 from the 100,000. And that's not what we want. There we go. $28,000, and we typically call this net income. So this should look somewhat familiar to you in terms of this is one of the most basic looking income statements that you've probably had some exposure to. So I shouldn't be telling you something new, but if so, hopefully, by reading the chapter, it'll make what I'm doing here look a lot easier to understand. And let me just put some dollar signs in here because I like to make things look nice. If you're ever wondering where dollar signs go in a document, typically it's usually the first number in each column and final answer. There's exceptions to that, but as a general rule of thumb, that usually is pretty safe bet. So the sequence that is typically done in accounting is the income statement is done first, and then that is followed by, if you're in a corporation, it's a statement of retained earnings. If you're in a non-corporation, it's called the statement of owner's equity, right? And I'll go through both of them just to make sure, and then when that's done, then you do a balance sheet. So let's do a non-corporation situation first. And in a non-corporation, you're going to have something called a statement of owner's equity. And then to the right, I'll do a corporation version of this statement of owner's equity. And by the way, when it comes to the income statement, you would never know, looking at this income statement, if you were dealing with a corporation or a non-corporation. So there's no clue in the income statement that kind of tells you that. All right, but when you get to the statement of owner's equity, you know immediately if you're dealing with a corporation or you're not dealing with a corporation. So in a statement of owner's equity, what usually happens is you start off with the owner's name followed by the word capital. And that's basically the company's beginning net worth. If this is the first time they're in business, whatever the owner put in the business to get it started. So let's pretend it was $10,000. This net income answer that we got in the income statement, that would then get added to our beginning capital. So we would write something like add net income, and we would add that 28,000, and that would bring us up to 38,000. We don't have a fancy name for this, so usually the word subtotal would suffice. Then we would subtract out whatever the owner took out of the business for personal reasons. And we refer to that as either drawing or withdrawals. And let's say this person took out, $4,000 for personal reasons. I like to do my subtractions in red. That's a common thing in accounting. You guys don't have to do it, but if you see me do it, it's kind of like a habit that I have always been in. And this gives us our ending capital. And let's give that first number a $sign, and then the last answer a $sign. And then your documents always end with double lines. That's to show conclusion. So the purpose of the statement of owner's equity is to determine the company's net worth. Whereas in the income statement, the purpose is to determine the company's profitability. So make sure you write that down, rewind the recording if you need to. Again, the income statement determines the company's profitability, and you get that by going revenue minus expenses. The statement of owner's equity determines the company's net worth. If this had been a corporation, I'm just going to copy the entire thing and then just tweak it. So if this was a corporation, instead of having capital, what you would have is retained earnings. So retained earnings is the equivalent of capital in a corporation. That 28,000 in here. And instead of drawing, what you would have is dividends. So basically these two documents are almost identical. They're both doing the exact same thing, except in a corporation you don't have one owner, you have thousands and thousands of stockholders, and the stockholders are the owners. So instead of capital, we use retained earnings. Instead of drawing, we have dividends. Okay, so this is what we call a statement of retained earnings. But as you can see, they're basically the same idea. Okay. What follows after this is the balance sheet. And chapter 4 will focus on this balance sheet and the pieces associated with it. And also in chapter 4, we'll get into cash flow statements. So we'll focus on income statements, retained earnings, mostly income statement in this video. And then the next video you see will focus on balance sheets and cash flow statements. Right? The balance sheet is basically the accounting equation. So you start off with assets, and then you have, a breakdown of those assets. I'm not going to get into all the detail that we will in the next video, so this one's just going to be basic. But things like cash, accounts receivable, equipment, accumulated depreciation, things like that. Again, just want to keep things super simple here. Believe me, next week's video will be a lot more detailed when it comes to the types of assets that appear in a balance sheet. But again, I'm trying to keep this somewhat simple because it's not the objective of today. And then under liabilities, these are your debts. So like accounts payable, notes payable, wages payable, unearned revenue, things along those lines. And then you have your owner's equity. And this is where you put in your capital, your ending capital from the previous document. And then the last line is called total liabilities and owner's equity. stretch this out a little bit here. So let me just make up some numbers here. First off, the capital I'm not going to make up. I'm going to take the 34,000 from there. Let's pretend that the accounts payable were 26,000. So if I were to add these two numbers together, 26 plus 34, that's going to be 60,000. Now normally when I get to this point, I would already know what my top answer is, but I'm just kind of winging it here in terms of the numbers. So let's pretend, our cash is 30,000, accounts receivable 5,000, and whoops. We'll make our equipment 25, and I'll add these guys together, and hopefully it equals 60,000. It is a balance sheet, and whenever you have a balance sheet, you are expected to balance. So that is the automatic assumption. So if your balance sheet doesn't balance, you've made a mistake. So that's kind of like a non-corporation version. Let me show you how different it would look if this was a corporation. And the difference would be here, instead of owner's equity, it would be called stockholders' equity. And instead of capital, we would have two things. And let me just get rid of this. So instead of owner's capital, we would have basically a stock account, common stock, preferred stock. I'll call it, just to be generic, capital stock. And we would also have retained earnings. Okay. So in this particular case, I'm going to have to improvise with the numbers. Let's pretend this is 4,000 and this is 30 for a grand total of 34. And then I would add that 34 to the 26, and that would give me the 60,000. Doesn't translate beautifully because I had to turn one account into two separate ones, so a little bit of an issue there. But I just wanted to, the whole point was just to show you a comparison of the two. So you can tell when looking at a company's balance sheet if they are a corporation or they're not a corporation. You can tell by looking at the equity section, but you can't really tell by looking at the income statement. Okay, so we'll do a little bit more with balance sheets, a lot more with them in the next video, but the focus really today is the income statement. Okay, so this was the most basic income statement that you probably saw in your first accounting course. So let me just copy this. Let's create a new sheet here. So another version of an income, and there's so many different ways you can do an income statement, but This one that we just did here is more for a service company. And you could have one for a merchandising company as well. So let's look at an example of a merchandising company. Now, when I say merchandising, the difference between service and merchandising is service, you're performing a service for a customer. Merchandising, you're selling them stuff. So you might be more familiar with this look where you have sales. Instead of just revenue, you've got sales less cost of goods sold. I don't know if these words sound more familiar to you. Cost of goods sold is usually commonly known as COGS. Some people refer to cost of goods sold as cost of merchandise sold, and this would be called COMS. Either way, it's the same idea. And you'd end up with something called gross profit. And then all those expenses that we had would be here. And let's say our sales were, in this case, $120,000. Cost of goods sold. Let's say that's 20,000. And that would give us a gross profit of 100,000. So what is cost of goods sold? How much it costs you to sell the stuff that you're selling. So if you're selling something for, $120,000 and it costs you 20, you made a profit of 100. But then you also got your own expenses that you got to deal with. So, selling something for 120 ended up being only 28 in net income, and this is before tax. So, may look good originally, but then when you take all your costs out of it, all your expenses, it may not seem so hot after all. So anyways, of these two that you're looking at here, the income statement that is most like what you see in Chapter 3 is like the very first one you were exposed to. Okay. So I guess that's good news, except that there's a little bit more detail than what you see here. So let me just kind of show you what that income statement looks like in your textbook. You create another one here. So let me just put income statement up here, go textbook, income statement. And the one that they have in your textbook looks something like this. So they start off with operating revenues, and they have different kinds of revenues because we're in a medical environment here. So one of them is patient service revenue. And something that's unique is that in this industry, they put in up here something called provision for bad debts. Normally this is called bad debt expense, and it shows up as an expense in the expense section. But in most recent years, they've decided to kind of bring this up into the operating revenue section, kind of like, how we had subtract cost of goods sold from the sales and that gave us our gross profit. Well, we're kind of going to do something like that. All right. So I'll even use the numbers that they have in your textbook here. So let me put this in accounting mode. So for example, they have 150,118 as, as the amount of patient service revenue. And then of that 150,118, for whatever reason, they think they will not see 2,000 of that. So that gives you net patient service revenue of 148,118. Then they have something in this section called premium revenue. Now you may have to read a little bit more about premium revenue, but to make a long story short, this is revenue that you get from patients for services performed, but they're actually capitated patients as opposed to fee for service patients. So let me do a quick little definition here. So let's talk about fee for services patients. I forget the word F and fee. What the heck? All right, fee for services patients. This is patient service revenue. And then you have basically capitated revenue. It sounds such a bad word, capitated. It sounds like decapitated. And this is payment received from healthcare providers and this is kind of like it's a set amount for enrolled patients. Kind of over a period of time. So all of this would, you got your patient service revenue and then you got your capitated revenue, and this is more like what they're referring to as premium. So if you read the chapter, you'll see what I'm talking about when you see the word, capitated. So again, with premium revenue, promised to provide future services is kind of like how premium works. Whereas patient service revenue, that's more like payment for services already provided. So another way to kind of look at it. So anyways, the premium revenue that they have in the book is about $18,782. And then they have some other revenue. And that could be revenue from so many different things. And they got that as 3,079. Like, for example, last time you went to visit someone at the hospital, did you have to pay for parking? That would be considered like other revenue. Okay, it's like parking revenue. They could literally list it as a parking revenue, but they don't. So that could be a good moneymaker for a hospital. So the net operating revenue that they have here, when you add these three together, the net patient revenue, the premium revenue, and the other revenue, that gives you 169,979. Okay. And then we get into the expenses. And they've got a whole slew of different expenses. They got salaries. I had wages in my other example. Salaries and benefits. We've got supplies, insurance, lease expense, depreciation expense, and interest. So let me just jot those numbers down. 126, 223, and 20,568, 4518, 3189, 6405, 5329. And I'm actually going to move my totals into the other column here. And that comes out to 166,232. That matches what they have in the book. So we call that total expenses. Now we're going to subtract the total expenses from the operating revenue. So 169,979. Subtract out the 166,232, and we get that 3747 that you see in the book. And we call this operating income. Some people will call this something different, but because they threw interest up in here, I can't really give you the other name, but typically operating income is the same thing as EBIT, and EBIT is earnings or income, earnings before interest and taxes. So I can't really get away with that in here because they threw interest up in here in the expense section, which is a little unusual, to be honest with you. Right? But that's what they have in the book. I personally would not have done that if I were doing this. Then they've got some non-operating income. And some non-operating income that they have, they've got contributions that they receive and some investment income. It's possible they could have some gains from selling some of their equipment, so that's always a possibility as well, but they don't have that in this example. So if we add these two together, that's going to give us a total of 4113. Add that to the 3747 up above. And that's going to give you your net income before tax. So total non-operating income is the 4113, and this is your net income. And I'm just going to write in here before taxes. And that's the income statement that they show in your textbook. What the heck? There we go. So they go through and spend a few pages breaking down each of these sections a lot more in depth than maybe what I just did, but hopefully what I did kind of helped explain where some of the numbers came from. Okay. And that takes up a majority of the chapter. So hopefully, you know, once you see this, you can kind of go back and look at the textbook and kind of follow along. I noticed I happened to open up in your textbook and I noticed self-test questions. And one of the self-test questions is, why is net income called the bottom line? Because it's on the bottom line. And a lot of times, you know, I don't mean to pick on the experts, but there's a lot of people that are like bottom line dwellers, meaning that they just look at the bottom line and say, oh, this company is doing great, or they're just doing lousy because of what the bottom line is. You have no idea how much manipulation can take place from the top to the bottom, and it could completely distort that bottom line. So if you're basing your answer on, oh, that's positive, good. Oh, they ended up negative, that's a loss, that's bad. You'd be in for a rude awakening because there's a lot of other stuff that might be going on that you're completely missing. Okay. The difference between net income and operating income is another question I'm seeing there. And you can see here's your operating income and here's your net income. It's possible they could be the same, but if you have any other revenues or other expenses, there's a difference between the operating income and the net income. Okay, and then this net income, the next question I'm seeing in your book, what happens to net income? This number gets transferred into, remember our first page here? Net income gets transferred into the equity statement. So whether if it's a non-corporation, it gets added to your beginning capital. If it's a corporation, the net income gets added to your beginning retained earnings. Okay. I'm also seeing something related to depreciation in your chapter. And in depreciation, basically, what is depreciation? It's a cost recovery system. It allows you to spread the cost of an asset over time. So it spreads out the cost of an asset over time by taking depreciation expense each period for the life of an asset. So let's look at the most basic form of depreciation, and that is called straight line depreciation. And in order to calculate depreciation, you have to work off of a formula. And the formula goes something like this. Whoops. My mouse is acting up. Looks like I gotta change the battery on this guy. There we go. So the way the formula works is in the numerator, you go cost minus salvage value What is salvage value? That's what you expect to get for this asset at the end of its estimated life. So it's kind of like, when you trade your car in, you get like a trade-in amount, a trade-in value. That's the same thing as salvage value. I've heard trade-in value, salvage value, scrap value, residual value, all mean the same thing. So you're going to take this cost minus salvage and you're going to divide by the estimated life. We start off by doing it in years, and then you can eventually convert it into months if you want to. So that's the formula that we use for straight line depreciation. So let's pretend that the cost of an asset, let's create some data here. So let's say the cost is $100,000. Let's say the salvage value, I'll just write SV. Let's say the salvage value is $10,000. And let's say the estimated life is 5 years. So from this data, let's calculate depreciation. So the cost is $100,000. And the salvage value is 10. The estimated life in years is 5. So 100,000 minus 10,000 is $90,000. So if you take 90,000 and you divide by 5, take a few seconds and see if you can figure that out. If you came up with 18,000, great job. That would give us $18,000 a year in depreciation. So every year, this company or this individual, doing the books for the business would be able to depreciate 18,000. So remember over here, this depreciation, so they got 6,405. I have no idea, looking at their depreciation, if there's just one asset that's being depreciated or there's quite a few, and how many years. I can't tell from this. All right, there's no way of knowing. But if we were working with the example that we have here, it would be $18,000 every year for 5 years that we'd be able to get a write-off. So when you see depreciation in the textbook, in your chapter 3, you'll have an idea where that information came from. Okay, let me just take a look at the rest of your chapter here. I think those are the main things that were covered. So for homework, what I would like you to try would be on page 113. You got problem 3.2. And again, like I said, I will be uploading the solutions to these end of chapter problems so that once you do them, you can kind of compare and see how you did. I would also like you to do problem 3.5 on page 114. So the homework starts on page 113. And let's see if I want to throw one more your way here. Yeah, 3.7. And 3.8. I think those are good ones to play around with. Okay? So the plan going forward is once you listen to this recording, what I need you to do is write up a short 1-page or less summary of what we talked about. Give me some examples of what we did in class, and then email that to me. So for homework, first thing you want to do is email me a summary of today's session. You do not email me your answers to these problems. I don't need to see your homework solutions because I'm going to supply you the answers. Okay, so for homework, email me, and then I'm going to say try on page 113, try these problems, and then review your answers with the answer key that I will provide. Okay. So the only thing you got to email me is a summary. The homework you will do on your own, and then you'll compare that to the answer key that I provide you. And then we'll go through the same process next week with chapter 4. And then in week 3, there would be no video. In week 3, I will upload the test. Okay? And then you'll have a week to work on the test. So how do I take attendance? I take attendance from your emailed summaries. And then test week, I take attendance from you submitting your tests. And that's how that's going to go. All right? Well, I hope it wasn't too boring for you. It's kind of dry material, but if you need some extra help with this material just in general, I do have a YouTube channel where I have tons of accounting videos. So feel free to go in there and see some of my videos there. Some will be directly related to what we're talking about. Some will be more generic. But I think they could prove to be very helpful for you. But this is my YouTube address, and I've got 30 something accounting videos. I even have some cooking videos and some Christmas singing videos in there. So, try not to get lost into that rabbit hole, but see if the accounting videos might help you in terms of financial statements and doing accounting and things like that. All right, that's all I have for you today. We'll talk to you soon, and look for that next video to come out. All right, bye-bye.